people who missed it, I would just give a brief intro about me. My name is Ajay Vaswani, and I look after business development side of alternate funds at ITI, that is the Investment Trust of India. ITI is the listed financial services conglomerate having diverse business portfolios of asset management, investment banking, stockbroking, advisory, and lending. Now, I would like to take this opportunity to introduce my colleague who is on this webinar with us, Mr. Rajesh Bhatia. Rajesh is MD and CIO of ITI Long Short Equity Fund. He has 30 years of total fund management experience and the last 12 years in managing long short equity strategy. Today in this webinar, we shall be covering the following topics: global market trends, developed market actions and implications. We'll cover Indian markets, challenges and opportunities. Then we'll cover equity market strategy and the path forward. My suggestion is let's keep this webinar more interactive and have a very active Q&A session post the initial presentation by Rajesh. Now I would like to request Rajesh to take you through the insights. Rajesh, on to you.
Yeah. Hi. Thank you, ladies and gentlemen. My name is Rajesh Bhatia. Thank you for the opportunity. Today, I hope to share some, insights that we've had on the latest trends of global markets as well as the Indian markets. Ajay, could you go on to the next screen, please?
Yeah.
Yeah. So, this year 2020 has been really a year of perplexing market movement. It has been an extremely unusual time because we've had a synchronized global equity meltdown, particularly in the month of March, where equity markets globally swooned 30% or so. And this was one of the fastest declines ever recorded. And surprisingly, there was an equally sharp bounce in April onwards, to such an extent that the American market, NASDAQ, which is really has a lot of technology companies as its constituents, was positive for the year. And, this has left a lot of stalwart across the globe perplexed as to what has really happened. Because we are in a once in 100-year pandemic, right, of which can have very, very large magnitude of challenges. And according to the IMF, the global economy will contract by 3%, which is the sharpest decline since the Great Depression of 1929. And yet, the equity markets have responded with such vigor. And so it's very instructive to understand what are really the forces or factors that is leading to this event. As a student of financial markets, whenever an unusual event happens, whenever a mania happens or a bubble happens or crashes happen, it's always instructive to kind of step back and ask the question, what caused this? And develop knowledge or insight around that. And I wouldn't even restrict this to market movements. Even when sectoral changes happen, right? It's always instructive to ask, for instance, why did 12 players enter the telecommunication business in India in 2011? Why did so many large industrial houses want to set up power plants all at the same time in between 2004 to 2008? Or, it could even be micro. Why does one company succeed superlatively in a particular sector whereas the others struggle, right? So whenever you ask these questions, you get a lot of insights as to what has happened. And when you collect these mental databases of insights, that converts to knowledge. And it helps you to take advantage of opportunities, ahead of time. Well, the best money in the equity markets or in the financial markets is really made when you're able to see something ahead of markets. And when you collect these kind of understanding of insights, you gain a upper hand when you play the financial markets, because history, while it doesn't repeat, it certainly does rhyme. Uh, Also, I think it's important to understand what has happened in 2020, because I think the global financial ecosystem has changed. So, as a person in finance, it's imperative that you understand what has really happened. Um, Also, there are people who ask me, is it not enough for me to do just bottom-up work? Can I not just buy Bajaj Finance or Asian Paints, from a bottom-up perspective as an investor? Do I need to understand top-down? I think we are in a world where top-down, understanding the top-down is becoming increasingly important, right? So if you look at economics, right? Today, we are at a phase where you are at, the lowest level of interest rates in human civilization. Now, that has significant impacts on how you value businesses or even assets across. Political. Today, the United States, which is a $21 trillion economy, is loggerheads with the second largest economy, which is China, which is $13 trillion, of GDP. Both together have a combined GDP of $34 trillion of a global GDP of 85 trillion. And both are vying for leadership. There is massive implications of these political changes as they happen. Technological. Uh, you know, some people argue that we are in the cusp of the greatest technology revolution ever seen in mankind, right? And how these technologies kind of evolve is going to determine the future of several businesses, business models, cost structures, etc. Uh, I'm not for a moment suggesting that we become experts in economics or politicals or technology. Beyond a certain level, the incremental value add, is not value accretive. But it's very, very essential to build a business basic framework around these top-down changes and understand the implications of that as you approach the financial markets. Ajay, could you go to the next slide?
Yeah.
Yeah. So, what has happened is that I think the world has changed a bit since 2008. And we had the great financial crisis in 2008, where the central bankers across the globe decided to launch an experiment called quantitative easing, which is a very sharp increase in money supply. I think the top 6 central bankers of the world increased their balance sheets from 600 billion, 4 trillion to about $16 trillion. So that was a very large increase in money supply that took place across the world. And their hope was that, of course, they wanted to prevent a Great Depression from 2008 and prevent deflation. And they were hoping that over a period of time, you will have a normal business cycle and the onset of inflation at a time where they will be able to unwind this large increase in money supply that has taken place. But instead, what they got was asset reflation and a rise in debt. The US S&P has gone up 5 times since that phenomena. So asset prices have gone up. So the liquidity, instead of going into as much the real economy, has more seeped into asset prices. And increase in debt. The US corporate debt, as we speak, is at a 5-decade high. So companies said, if interest rates are so low, and as we speak, about $14 trillion of fixed income is at negative interest rates, then I would rather raise debt at such low prices. Even in 2019, $1 trillion or so of buybacks took place in US corporates, and the US market cap is about $20 trillion. So 5% of the market cap was bought back by issuing debt. So there was a little bit of abuse that took place in the system. And given that investors were hungry for yield, because as I pointed out, $14 trillion of paper is trading at negative yields. There are pension funds, hedge funds, investors looking for savers, looking for a positive yield. They took even more risk to get a higher yield. So they dropped covenants, they dropped the loan to values, etc., and created a bit of a fragile financial system, right? So in America alone, 2/3 of non-financial corporate bonds are rated junk or triple B. And if given the pandemic, a lot of the triple B would have also evolved to becoming junk. And in comes the COVID issue. And the COVID would have exposed this large financial fragility that we've had. Because what COVID has done was that you have to shut down entire countries. You have to shut down entire businesses. So let us imagine that you're a hotel, right? 80 or 90% of your revenues collapse when your economy is down or shut down. And which means that whatever your fixed cost structure becomes your EBITDA loss. And if you're leveraged, you're even in more trouble because you require working capital, which is already stretched. You require incremental debt. Why debt? You even require more equity, which means you could go into bankruptcy very, very quickly. Now, central bankers across the world realized that we were into a financial system, fragile system, and they acted very, very fast. And they have responded in a very, very forceful way, I would say. And they have, so just the United States alone, which had increased its balance sheet from 600 billion to 4 trillion between 2009 to 2019, is decided to go from 4 trillion to $10 trillion. Not only that, the US fiscal has decided that they will issue $3 trillion of debt, which is on a GDP of $21 trillion is about 15%. Not only that, they will add probably another $3 trillion to the fiscal deficit. So we are talking about a monetary stimulus of about 30% of GDP and probably another 20 to 30% of fiscal stimulus. That's 50 to 60% of GDP in the United States alone. And they are now not only willing to buy treasuries, they're even willing to buy junk bonds. And this is across Europe as well as Japan. So this large increase in money supply is extremely important to take note of as financial participants because it has distorted asset pricing, right? And even though we are in a pandemic and even though we are challenged with a kind of a sharp slowdown, asset prices have risen. So one way to look at that is, with interest rates in, let's say, the US at or 10-year yield at 0.5 to 0.6%, right? Which means if you were investing in fixed income, you wouldn't really be making any money. And governments buying, the Fed buying bonds and reducing the spread on bonds. What is the message that goes to the equity markets? That you have to buy equities. If corporate spreads are declining and there is very little debt interest on the debt part, you're forced to go to the equity markets where at least you're getting 2 to 3% on dividend yields. Also, the challenge for any investor is if your interest rates are so low and if you printed so much money, isn't there a threat of hyperinflation? So shouldn't I worry that if I did invest in fixed income today, I could actually lose money as interest rates went up because of hyperinflation? So there is a bit of a TINA factor. There is no alternative but to invest in equities, and which is causing this massive asset price distortion, across the globe. But as financial market participants, I think we should be concerned that in spite of a quantitative easing experiment of more than a decade, that the developed markets have not been able to restore a normal business cycle. And with that experiment failing, they are even upping the game more with these current moves, right? Should you expect anything different than what has already happened, which is all this liquidity will seep into asset markets again, which is what is really happening, right? And that you will continue to have anemic equity or economic growth. So you should ask the question, is QE now a new normal, right? And what wouldn't it trigger even more debt as you move forward and more fragility of the financial system, right? And what has happened is, what we have seen successively is anytime there is a economic weakness, Fed comes to the rescue and issues more currency or lowers interest rates. So you have got into a system where it's bubble or nothing. You can have large rises or collapses. So my sense is that as financial market participants, you're going to see even more macro-driven markets. What you have seen in February, March, and April, May is par for the course. While security selections will make a difference to investing, I would say that a larger portion of your returns will be guided by how you react or how you've dealt with macro-driven markets over a period of time. So why should we understand what's happening across the globe? I mean, we are Indian investors. What have we to do with, what happens in America, or you see, what happens with Europe or Japan? Now the thing is that you notice that when the 30% decline took place across the globe, it took place across the globe, including India. Global markets ebb and flow together. Also, foreigners own 40% of India's free floating stock. Now, what does that mean? So if the entire market capitalization of India is about 100, 50 to 55% of that equity is held by promoters. So whether it's government of India, whether it's promoters or private companies, etc. They own that equity, which doesn't come to the market. So the free floating stock is what is the balance, which is 45 to 50% of the entire market cap. And of that, 40% is owned by foreigners, right? And so if you notice, since February, DIIs, which is the local institutions, bought $9 billion of equity. But foreigners sold $10 billion of equity. So that $9 billion of buying was negated by the foreigners, which sold $10 billion, and that led to the 30% decline. So it's important to have a framework as to understand what are some of the global risk on and risk off frameworks that are taking place across the globe. So it helps you to invest a little better, as far as even Indian markets are concerned. Ajay, can we go to the next slide? Yeah. So now coming to India per se, India challenges and opportunities. Well, for the moment, it's more challenges than opportunities. But, this too shall pass. Coming into this pandemic itself, India was already in a slowdown. You would have noticed that we were complaining our GST revenues was not meeting what we aspired for. And auto companies were reporting very, very, weak sales, etc. And cement companies were reporting weak sales, etc. So we were already in a bit of a slowdown even before we came into the pandemic. And one of the challenges that we had was our fiscal deficit, which is the government's revenue minus expenditure divided by GDP, was on the central level, on the state level, and the off balance sheet level was already at 9% of GDP. And that was typically crowding out the household savings that were available. And which means there was inability to reduce interest rates in India such that could provide fillip to the growth, right? And so we were already in a very, very challenged environment. And if you notice what is happening across the globe, it's really the governments coming to the rescue. And what I'm telling you is that even before we came into this pandemic, India had challenges to support our economy. The challenges have increased even more. And while I think the steps that have been outlined by our Honorable Finance Minister have been really commendable, a lot of this is really not fiscal support. I mean, while there are guarantees that have been given. It's not as much of fiscal support, and I can understand the challenges that they face. While the steps are in the right direction, it may fall short. And the COVID, I mean, I think we've had one of the most severest lockdowns across the globe. And yet, unfortunately, even at this such an early stage of the COVID pandemic, our hospitals are bursting at the seams, which should be a bit of a cause of concern. So the COVID has been a bit of a demand as well as a supply shock. And I think you've seen estimates of various economists. So I've read one forecast which says if the economy is locked down for 40 days, then the GDP of India will be at 0% for financial year 21, right? Because what they've assumed is per month is 8% of the entire annual GDP. 50% of the GDP is closed because rural is not as impacted and not all activities are going to stop. And that 50% stops. So therefore, the monthly impact to GDP is about 4%. Now, the challenge is that the longer the lockdown, right? So that they've assumed a 40 days. But longer the lockdown, greater to the damage to the economy. And given our lack of ability to provide stimuluses to the economy, the longer will be the time to recover. And that's really a challenge that we have. And a lot of experts would argue that, while we are still in the early stage of the first wave, it's very possible that you can also have a second wave. And you could have, when you talk to a business person, right, he's manufacturing. How does he plan for manufacturing? He has a challenge opening his factory because whether he has all the migrants workers available, what if suddenly a green zone turns into a red zone and he has to stop production? His suppliers are in a red zone, whether he's in a green zone. What if his distributors are in a different zone which prohibits his sales efforts and so on and so forth? So it's a very, very difficult time for even to even plan what the likely outcomes in this phase. And who says the pandemic will last only 2 or 3 months? What if it lasts longer? I'm just saying that these are questions that we don't have answers to. So it's very possible that the pandemic lasts only 2 months and it's kind of suddenly goes away. We find a vaccine very, very quickly, which seems unlikely, though, if you listen to experts who say it's at least 12 to 15 months away. We get herd immunity. We could get lucky. So those are also possible, but it could drag on for much longer, which means that the range of outcomes is so large that it's very, very difficult to forecast. And that's a challenge that we are seeing with individuals and corporates. And that's going to lead to changes in how they behave. Corporates are already talking about no more capex, no more hiring, right? Reduce salaries wherever we can, reduce cost structures, no more advertising. All of this will have impact on your growth. What are individuals doing? They will say, let me save more, let me not spend. And again, that has implications for demand as you move forward. The economist carried a cover story called the 90% economy, that even where the pandemic has been addressed, let's say something like China, they're not seeing a full recovery of the economy. And so if people refuse to go to bars or restaurants or theaters or, so on and so forth, it has a bit of a permanent downward shift to demand for the economy. So I think we are in a fairly challenging period to forecast, to say the least. And even if you're a little bit optimistic, you should say the recovery of the economy will be a little bit U-shaped than a V-shaped one. And that's the best we can hope for at this moment. Having said all that, India is really a land of opportunities. And the opportunities for us is, amongst the $2 trillion, $3 trillion economy, I think we have the youngest population. I think the average age of Indians is about 31 years. And over long periods of time, it's been proven that if you have a young demographic population, you are best placed to grow GDP at an attractive rate. Because you have younger people you have more hands to work, you have younger people who want to consume more. So it's the younger people who want more cars, more televisions, more air conditioning, and so on and so forth. That's a challenge for America, Japan, Europe, and even China. So if you look at which can be a large growth spot in the world, which can be a large captive market, it is really India. India is also very uniquely in terms of our political structure, always reacts because we're a democracy of a kind when we have our backs to the wall. So the 1991 transition from a socialist structure to an capitalist structure was done in an extremely quick way without much argument, right? And so we can be optimistic that a lot of restructuring of painful areas will get triggered because this pandemic has taken place and we are challenged financially, which could lead to a structural growth in our markets for the long term. Also, I think the rhetoric at this moment globally is that people are really upset with China. I mean, it's across Japan, across Europe and America, that they are now looking at alternatives to these Chinese investments that they've made, and they want the supply chain to move away from China. And clearly, I think we could be beneficiaries of that trend, because where will you get a captive market as large as India? And so manufacturing economics may make sense to not only manufacture for the domestic market, but also for the export markets. So I think, we could be positioned very well as we emerge from this pandemic. So, the path forward, I think as I look at this difficult stage, but I think this is the moment for long short equities. And why do I say that? I'm not the only one. Just a few days ago, Stanley Druckenmiller, well, you shouldn't ignore him because he has a 30-year track record of compounding at 30% per annum. It's one of the best track records in the world as an investor. And he started off as the right-hand man of George Soros. And he said he thinks that the long short opportunity is the best he's seen in the last 10 years. And why do I think this is a terrific moment for long short? Because while the macro is uncertain, there are clear trends that are emerging from a bottom up. And there will be sector winners, stock sectors winners and losers, right? So you look at an example, right? So let's say I give an example of a hotel, right? So the revenues for hotels will certainly be challenged, or any travel will certainly be challenged. So the P&L impact that a hotel could see could be very, very large. But that may not be true for, let's say, a telecommunications company. Who wants to disconnect a telecommunication service at this moment? In fact, the need for telecommunications has increased even more. So, the P&L impact could be extremely low for, let's say, a telecommunication company versus a hotel company. So you could actually be long a telecommunication company or short a hotel company. And there will be varying impacts on balance sheets because of damage to leverage players. So if you are levered in this environment where demand is collapsing, that could have a significant impact on your future, whether it weakens you or takes you out of the game totally. There could be beneficiaries of consolidation. So it's possible that some people exit these businesses. I would say that you can see that a lot of NBFCs will go out of business. They'll decide not to be in the business, as you move forward. So the larger players in that business could, consolidate and emerge stronger. And then there is the emergence of e-commerce, right? And which is again an opportunity. So companies which are geared more towards digitally servicing their products could emerge, winners, as you move forward. So the point I'm making is that if I constructed a portfolio of longs, right, which I think are attractive, so that let's say it could be telecommunication companies, IT companies, insurance companies, etc., and shorted a bunch of other sectors. Let us say something like the lenders. I think the lenders are extremely challenged, at this moment because they are also leverage players, and a lot of the pain of the economy they will eventually feel in their own balance sheets. If the markets go down, chances are that the lenders will go down more than, let's say the telecommunication company. So you could still make a positive return even as the markets go down. Or the corollary, if the markets go up, right, the telecommunication companies could go, higher than the lenders. So, it could be an opportunity. And there's a third option, which is with very, very little market risk exposure that you're taking, you could have both, best of both worlds, which is telecommunication could go up and lenders could go down. So that's why I think that it could be a great opportunity for long short to demonstrate a great performance by long short equity managers. So with that, I'll kind of conclude my comments, and I'll be very happy to take questions.
Thanks, Rajesh. We'll now go to open the Q&A session, and I would request the participants to write their questions in the chat box. Rajesh, in the meantime, while people are typing their questions in the chat box, there are some questions which I also received on WhatsApp from the people who are attending this. So till these questions come up here on the chat box, I would like you to address them. So can we start now?
I'm ready.
Yeah, Rajesh. So there's one gentleman who has asked that, do you expect markets to be higher or lower in next 12 months? Indeed, it's a difficult question to answer, but I would request you to attempt.
Yeah, I think even in normal times, I would have a challenge answering that question. But, as I kind of outlined, what we are going through is truly unprecedented. There is no, this is not a normal business cycle. We don't know the possibilities, as you move forward. Forecasting, therefore, is even more difficult. So, I would say that, like I pointed out earlier, one of the best ways to make money in the equity markets is really if you're able to see ahead of the crowd. And when you have that database of knowledge or insights of markets, and if you're able to see an opportunity ahead of the market, that's really the best way to make money. But the corollary to that is, if you are not, the worst way to lose money is when you're not able to articulate a thesis as to why are you buying something to still make that bet. So I think at this moment, it's, as far as just the markets are concerned, I wouldn't say it's the right time to take that bet, because you're not going to be able to articulate a clear thesis as to what you can see as you move ahead. So it's better to take a micro, position, and I would say even a long and short position as you move forward than a naked exposure.
Okay, so here we will move to the next question. Then the next question, which has come from Amrish. Amrish is asking your views on NBFC sector.
Right. So clearly, I think the NBFC sector is really going to be challenged as you move forward. You're already seeing evidence of that. They've had to provide moratorium to their customers, but they are having challenges in their liability side. I think there are very, very few companies on the lending side where at least I believe they have the right lending DNA. Lending business is not very different from the investing business. I think there are two things that are required. One is skills, right? How you understand the market landscape, etc., and how you generate alpha out of those opportunities. And second is the risk temperament, right? And what kind of risk that you take, in the markets, and it's very, very similar to investing. And I think there are very, very few corporates whose lending DNA I trust. And we have seen this. You can look across the lending landscape, and you can see that there are very clear, distinct winners, in the lending side, and very, very bad losers on the lending side. So I would say that for me at least, I'm the way I approach the lending business is, you should know that it's a leverage business. It can be a fantastic business if you have a liability franchise which gives you low cost of capital, and you should know that in a growing economy like India. So let's say normal growth of the economy is about 10%. The lending business can grow at a multiplier of that, let's say 15%. And if you're a good player with a low cost, borrowing franchise, then you're probably growing at 17 or 18%. And then you're leveraged. And there is an arbitrage on the cost versus lending side. So the growth opportunity on a secular basis that you have, and has been demonstrated by various lenders in the system, is enormous. But for me to make that call on a long-term basis, I require that lending, DNA. So I trust very, very few lenders in this category, as you move forward. So there are very few, there are none. As we speak, there are no exposures to NBFCs that we have.
Okay, so now we'll move ahead to the next question. Sanjeev Gupta is asking, can we share this presentation? Yes, Sanjeev, we will be sharing this presentation with you through AIWMI, and you can refer this, and you can actually offline get in touch with us if you have any further queries. Now, Vipin Paliwal is asking, how can we take the benefit of the same situation as an investor as well as advisor? I think I'll take this question, Rajesh.
Sure.
Vipin, tell me one thing. As an investor or an advisor, I think whatever is best for the investor, that is the thing which is best for the advisor. So if as an advisor you are on the side of your investor, then there'll be no confusion. Your benefit is his benefit, and his benefit is yours. So I think there should be no confusion, and there should not be any conflict of interest between advisor and the investor. We can actually have a detailed chat on this if you want to connect with us offline. And it's actually a very interesting topic. Now advisors are actually seen as the part of the team of the investor, and not somebody who is just a sales guy to them. I hope I answer your question. Rajesh, we'll move to the next question. Another question which has come on the sector side, which I received on the WhatsApp again, is that can you talk about why telecom is a good sector to look at?
Yeah. So, my sense is that, this is I alluded to the earlier fact that, there were 12 players in this business at one point in time, maybe more per circle. It was a very competitive market, and rates crashed to the lowest, in the world. And now it has consolidated to two stronger players and one weak player. So there are three players now. And I think there is inevitability for rates to go up, especially if the government also wants revenues to accrue from the sector. So this sector has to become commercially viable, as you move forward. And I think one of the players has already said that unless rates are significantly higher, they will not be able to make incremental investments in, let's say 5G, etc. So I think it's inevitable, given the consolidation and given where rates are, that the economics of the business, have to improve. But one is the infrastructure layer of services in telecommunication, which is providing you voice and data. But I think as you move forward, I think my sense is that the competitive advantage of the future is really networks. What we call moats. Brands are moats, and low cost is a moat, and so on and so forth. Patents are moats. Ones which give you the advantage to have abnormal profits for long periods of time, right? So I think that moats of the future are really networks. I mean, look at the United States. There was somebody who sent me a chart that if you take the FANG companies, right, Facebook, Apple, Google, etc., the FANG companies since 2018 have driven the entire rise in the market, and FANG minus S&P is actually down 48%. I was surprised with that number. I don't know if that is true, but clearly, even now, as you see, the what's powering the market in the US as we speak are all the FANGs, the networks. And as you move forward, the networks will also take a disproportionate share of profits of the system. So that's a very unusual phenomenon. It's so you want to invest in networks for the future. So apart from the infrastructure layer that companies are building, the telecommunication companies are building, they are also building the application layer. And you've seen some moves from the largest player in this space, which is trying to build application layer. What if they are able to build a moat around this? Then I think they could probably build a moat. Of course, there are execution challenges, but if they were to build this, the opportunity can be very large. So apart from the base layer of economics of the telecommunication business improving as you move forward, there's also this added opportunity. What if they are able to build a moat around their application layer and can convert that into a network advantage, and that can be huge as well.
So Rajesh, as another gentleman who is asking if you can share your view on the auto sector as well in brief. Can you
Actually, the auto sectors are divided into many parts. There's two-wheeler, there's cars, there's commercial vehicle, and there's tractors. And even within that segment, there are many segments. For instance, Hero Motors is really focused on the lower end, the motorcycle market, whereas Enfield could be at a higher the higher range of the market and so on and so forth. But if I were to kind of put it succinctly, my sense is that it remains to be seen how consumers behave after this pandemic is kind of opened up. This kind of is kind of recedes as you move forward, and I think the uncertainty that I have, at least with automobile, is if the pandemic and the shutdowns last longer, the demand contraction can be longer as you move forward. So at this moment, I don't have any bets, at least on the long side, with respect to automobiles. But there are some fantastic franchises in this business. In the car segment, for instance, I would say even the cash flow business of two-wheelers is very attractive. The profitability across players in this business is very, very good. Whether it's two-wheelers, you look at most of the players, their return on capital employed, return on equity is very high. Their free cash flows are very high. The same is the case with the car manufacturer. And so is it on the individual tractor business, of the largest player. So I think the profitability of these businesses are strong, but I think I have a challenge forecasting demand, at this moment. So at this moment, I don't have any longs, at least on this space.
Okay, Rajesh, we'll go on to the next question. Now, Ganesh is asking, actually there are two questions mixed in one. So Ganesh is asking, what is different about long short funds versus long only funds? And also he has asked, are long short funds riskier than long only funds? So there are two questions. So I'll repeat, what is different about a long short fund versus long only fund? Also, are long short fund riskier than long only funds?
All right. So, long only funds is, as conventionally, I don't really need to delve into long only. They typically find stocks which, they can hold for, winners that they can identify and hold for the longer term. That's your typical long only fund. The long short fund also has two more, dimensions to it. One is that your ability to short, right? And I think that in today's time, that is a significant advantage, and I can tell you why. In India, we've seen uh, corporate governance issues, which become short opportunities. Over leveraged issues, where corporates have taken extremely high risk, which again become very short opportunities. Short cycles, we've seen several short cycles in the equity markets, uh, which lead to cyclical companies being challenged from time to time, which again become short opportunities. Um, and importantly, technological transition. As I mentioned, this is one of the most radical technology transformations that you're seeing ever. And therefore, there will be a lot of companies which will fade, uh, you know, as businesses. One can give the example of newspapers or even radio, for instance. I would say that broadcasting is facing similar challenges. You look at the price earnings ratios of broadcasters, um, and kind of they have declined significantly with the onset of OTT, etc. Uh, so technology certainly will play a decent role in identifying these businesses which will weaken over time. So as a long short fund, because I'm able to short, my canvas of opportunities increases more than a long only fund, right? Uh, and the other thing that one can do um, is dynamically change asset allocation. So when we see a risk of, let's say, a pandemic, a long only guy will have to inevitably hold his portfolio, right? But a long short manager can dynamically reduce exposure to equity. So let us say in this 30% decline, what if a fund could short, reduce exposure to equity to zero or even negative, and protect the entire downside? Now, so your 100 NAV would have gone to, let's say, 70. Now, the mathematics of declines is such that when your 100 goes to 70, for 70 to come back to 100 requires now a 42% rise, right? And what a long short manager, if he's able to protect capital, has done is not only has he protected your 30% downside, but he has 100% of the NAV ready to be invested at much lower prices. Now, that's a significant value add of a long short equity fund compared to a long only fund, right? And that's why I personally believe that this is a product of the future, because I believe that long only managers across the world have been struggling to generate alpha. And therefore, in the US, there is over a $10 trillion equity mutual fund market, over 6 trillion now, or about 6 trillion, which is larger than the active managers, is ETF. So I think alpha generation is becoming a challenge for long only managers, whereas there is opportunity to not only generate alpha, there's an opportunity to reduce risk, reduce volatility for an equity investor in a long short format. So I truly believe that's really the product for the future. As Warren Buffett has said, rule number one, don't lose money. Rule number two, never forget rule number one. And I suspect he says that also because of this mathematics of declines, right, that I pointed to. 100 rupees becomes 70, and it requires a 42% return to kind of come back to break even, right? In fact, a lot of startup investors, as you read across, will tell you it's a necessary condition that if you want to compound wealth at an attractive rate over long periods of time, you cannot go back too much. Because let's say if you have a year like 2008, right? So in a year like 2008, equity markets declined, I think, about 50-55%. Long only managers would have declined more than that, right? So, and I would say that it took some of these long only managers 6 or 7 years to come back to principal. So that's almost like a lost decade of returns. And as I'm pointing out,
I think, guys, we have lost Rajesh. I'll just check and get him reconnected. Forum, are you there? Can you hear me?
Yes, I can hear you.
Yeah, Rajesh is muted. He is already there on the call, and he is muted. So can you just please check it
Yes.
and unmute him? Yeah.
It's done.
Okay, Rajesh, can you speak now?
Yeah, I'm here.
Perfect. You're there. You're audible.
Yeah, I don't know where I got cut off.
Yeah. So you were talking
So I
about
don't know where I got cut off.
yeah, the long short. You're talking about the long short funds. They are they riskier than long only funds or not?
Okay. So yeah, basically, I think what I wanted to say is that I think there's a significant advantage to a long short strategy.
Mm. Forum, can you check? We are. I think Rajesh again. He got muted.
No, there is some, I think, network issue at his end because.
Yeah, I'm here back again.
Yeah,
Okay.
back again.
Hello.
Yeah, you're audible, Rajesh.
Can you hear me now?
Yes. I think network is weak, so probably you're coming.
So
yeah, please go ahead. We can hear you.
yeah. So the point I was making is that I think as you move forward, the long short product has merit because I think we are going to be increasingly even more macro driven gyrating markets. The canvas of short is a very significant value add, and this ability to navigate markets is an extremely important dimension to investing because it helps you protect downsides. Um, is long short riskier than long only funds? Well, there are all flavors, to long short funds. And in India, there are two types. One is, which are debt focused. They are a debt plus kind of returns oriented. And then there is the equity oriented long short equity funds. And again, just like the lending business or the investing business in general, um, there are the two things that, according to me, matter are skills and risk management. And in the long short business, you have to be paranoid about risk, the kind of risk that you take. So, there are theoretically across all long short managers, actually the idea should be you're taking much lower risk. The beta of the portfolio is lower than 1, as we've seen in the case of our fund as well. So you're supposed to take much lower risk. You will get much lower volatility as you navigate the whole cycle, and yet you will try to make an equity return. So actually the risk should be lower in the long short equity format. And I think even in this March decline that we have seen, Indian long short equity fund managers have done quite well, and they have not had the same type of declines, much lower declines than the equity markets have experienced, than the long only managers managers have experienced. So I think they brought a lot of value add, to this investment process. So typically, as the Indian long short managers have demonstrated, the risk is much lower than a long only manager.
Okay, Rajesh, I am getting continuous requests on the chat box and also on WhatsApp that there are many questions which we have to cover, the big lines. So the people are requesting if you could actually cover answers in brief, and because
Okay,
people are waiting for their answers.
sure.
And if anyone wants to actually chat in detail, they can actually connect with us later for a very detailed discussion on their respective questions. So I'll move to the next question. Here, the next question is from Ruchi, and it is again also related to the risk part of the fund, which he says that with the use of derivatives, would there be higher volatility in the fund returns and greater risk?
Like I pointed out, I think just because you use futures doesn't mean it is risky. It depends upon how you approach it. So, so basically, whether I am going long in a cash market, let's say a company like HDFC Bank, or in the futures, just because I'm using that instrument doesn't make it risky. What leverage I have and what type of companies that I have, that is what is really going to make it risky. Fortunately, in the case of Indian long short equity AIF3 formats, your leverage cannot exceed 200% of NAV, and really nobody goes. I don't know of any fund manager who does go to 200%. Most have 120% gross, which means including the longs and short, they are in the range of 100 to 120% gross, which means they're not taking any leverage. And so then it's dependent on the quality of companies that they have gone long or short on. And that's the skill I referred to. So the risk management is somewhat taken care of by the format itself. And then it's the skill that you bring to the table.
Perfect, Rajesh. Rajesh, the next question is coming from Ashish Khetan. And he's asking, does managing a long short fund requires a long short strategy requires a more diverse skill? And why did you actually switch from being a long only manager to a long short format?
So I think, of course, my personal belief, and it's considered, that's globally, it's considered that the long short equity format is far more intense than a long only format, right? Just more intense. I would say that whether it's good or bad is another matter, but it's far more intense. Actually, in the developed world, the best managers become hedge fund managers, right? All the big names that you hear of are all great, hedge fund managers. The two fund managers that Warren Buffett hired as CIOs to manage his money, both were hedge fund managers, right? Seth Larman, who's written the best book in investing called Margin of Safety, is a hedge fund manager, right? Whether it's Bill Ackman, which has a phenomenal performance, or it's Stanley Druckenmiller, who has a 30% CAGR in 30 years, are all hedge fund managers. So clearly, I think the skill required in hedge fund management is far more. I would like to believe. Of course, I could have a bit of a biased view here, but I think the skill required in hedge fund management is far more. Yes, that's really what I think.
Perfect. Rajesh, Subhaya has a very good question in the chat box. He's asking, shorting opportunities are not very liquid in India. Securities lending is not very developed. Long dated futures and options are illiquid. So how do we go?
So that's not really true. I would say that India is one of the few uniquely single stock futures market. And you have, I think the last time we checked, 75% to 80% of India's market cap was traded on the futures market, right? The companies with market cap of, which was 75 to 80% of India, is traded in the futures market. And Of course, size is going to be a constraint in the long short business as you move forward. But yeah, there's no problem of the ability to short uh, in India. I think it's a fantastic market, and it probably is from a risk mitigation perspective. It's better that you have futures than you borrow and short, because borrowing and shorting can get you called out, right? You've seen what short squeezes take place globally, and those take place when you are borrowing the stock. You can't get called out in the futures market. You can always roll it over.
Okay, perfect. Tunmoy is asking, what will be the investment horizon for ITI long short equity fund? I'll take this question, Rajesh.
Sure.
Tanumay, actually on this platform, we didn't thought of taking our fund specific questions as such, but as you are asking, see in this, in any kind of fund which is to generate a better alpha than the markets, you need to be there for a specific cycle, market cycle, and least market cycle should be at least 3 years. So anyone who comes in with the investment horizon of 3 years and plus will this fund will definitely fit very well in the portfolio of that investor. And though the fund is open-ended and the month exits are available once a month and investment is available 2 times a month, but we encourage investors to be there at least for 3+ years. If you want to get any other result related to this, you can connect with us offline. So now I will move to the next question, Rajesh. How will you value a company like Reliance, which has oil and telecom in this strategy?
No, that's a very detailed conversation. We can take it offline.
Okay, perfect. In fact, I can't even see the name of the gentleman who has asked here, so I would request the person can actually connect with me, and we can take up this detailed discussion on Reliance offline. Okay, now Abhishek Samal is asking the second question, which is long short funds versus market linked debentures for HNIs. So Rajesh, would you like, can I take this question?
Yeah, please go ahead.
Okay, see, Abhishek, every investor in its portfolio has a place for all kind of different products depending on the risk appetite and the specific goals which he has and to achieve. Now, you cannot actually compare long short funds vis-a-vis market linked debentures parallelly, because long short funds are the products which come in the equity category, and market linked debentures are more of the debt products which come between equity and debt. Okay, so though you cannot compare both of them, both have specific places in the client's portfolio, and both are suitable. We can connect offline to discuss in detail what and how market linked debentures work and how long short funds are different. So okay, now again a sector specific question has come, Rajesh. We'll have to answer briefly. What is the effect going to be on pharma sector?
Sure. Well, I don't consider myself as any expert in the pharmaceutical business. The typical exposures we've had is
Rajesh, Forum, can you check if he has gone muted again?
Yeah, actually, his audio is not available.
Okay, but he's not muted from your side, right?
No, he's not muted from my end.
Okay, so maybe some network issue. Till Rajesh joins back,
no, I'm back.
Yeah, he's back.
No, I'm back.
Perfect. So Rajesh,
Hello?
pharma sector, the question on pharma sector you were answering.
Yeah, I don't think I claim to have any great insight on the pharmaceutical business. The typical positions that we've had is really on branded pharmaceutical companies in the domestic market. We are, beyond the point. I don't think we have any great insight on how the international markets for pharma is evolving.
Okay, perfect. So let's go to the next question. Vishwesh is asking, what will be the growth of long-short fund space? Can we see more players entering this space given the lack of long-short managers? Rajesh, I'll take this question.
Sure.
Vishwesh, I completely agree that in India, the awareness about long-short fund space is much, much lesser than the developed markets. But now, as you see, there are good established players with the track record of more than 2 to 3 years and plus in performance. So that has actually increased awareness and understanding of the fund. And probably that is the reason I am seeing probably the second long short webinar on the same platform in just a span of 1 month. So this clearly shows that people are having interest in the long short fund managers going forward. So we are very, very hopeful that going forward, this particular space will see a lot of growth, and you will see good managers getting trained and coming and joining this domain. Okay, so now we move to the next question. Okay, what Karapeli asking, what are the sectors mainly benefited when the market starts going up? I think you covered it up in your presentation, Rajesh. Which sectors are expected to do well?
Yes.
Moves up. Now Rahul is asking, as we
look
say,
for where there's little P&L stroke balance sheet damage.
Yeah, perfect. Rahul is asking, as we say that recession is 2 quarters of negative growth, and right now just 1 quarter. So how these macro factors going to behave in next quarters, as like we have unemployment is at all-time high in India?
Yeah, so I think before I kind of go that I don't think we are saying that in this pandemic what you go long are winners of this pandemic. Maybe Netflix is a winner due to this pandemic. What we are saying is that these are good survivors, which you can go long on. So we are not finding businesses which will are beneficiaries of this pandemic, but better survivors as you move forward. And to the second question that was now asked, clearly I'm pointing out that I think we are still in the early stages of the pandemic, and there is uncertainty, huge uncertainty as to what could be the possibilities as you move forward. So I would say that it's very difficult to forecast what are the economic outcomes, as you move forward.
Rakesh Kothari is asking your views on PSUs in brief, quickly. I have a long line of questions, and I indeed don't know any.
Yeah, so I mean, I have not been. Honestly, I've not been a fan of PSUs because I don't think, I want to be in businesses where the owner interest, the shareholder interest comes first. While the managers of public sector enterprises are, very good and committed, whether shareholder interest is paramount for them becomes, a challenge. And so that's really what bothers me. Let's just keep it at that.
Okay. Vishal Navlani has a very big question. It's a big statement. I'll just read out and you give your view. Sir, my fear is that this government is taking more and more authoritarian and may ruin livelihood of lower strata of society. Some of the top leaders in government are quick in taking decisions, but take very tough decisions which often affect the economy in a wrong way. What is your take on this? So he's predominantly asking that government is taking some tough decisions which may affect the economy in the wrong way.
Yeah, I mean, I can see one thing I've learned in the equity business is not to dwell too much into which ideology you support, whether it's religious, political, or otherwise. It prevents you from thinking rationally or clearly. So, I would rather skip this question, please.
Yeah. Okay. Now,
Not make any political, comments. Yeah.
Ashish Nandi is asking, in long short strategy, how currency fluctuation risk is taken care of?
Well, we are the investors that we have in our fund are INR investors mostly. So we really don't. The fund doesn't really invest in any currencies or does have any currency risk. Of course, the companies that we invest in could be vulnerable to currencies. If they're importers, then they can benefit or lose, as the currency fluctuates, and if they're exporters, similarly. But that's really a portfolio decision. There's not any single currency-wise portfolio impact that we have.
So, if Rajesh, another question which is coming is, what is the effect on public bank as they are providing moratorium and rising NPAs? How RBI will behave?
I like I pointed out, some of the public sector banks are challenged, as enterprises. I mean, they're doing a great job. Are they investable for me? They can be good trading bets for me, but can I articulate a thesis over 3 years or 5 years as to why I want to invest in these enterprises? Unfortunately, given my checklist, you have basically a checklist of some boxes that you want to tick before you accept an investment as a part of your portfolio. Some of those criteria that I mentioned do not qualify for these public sector banks. So they may become good trading opportunities at some point of time, but for me, they are not necessarily investing opportunities.
Okay. Mahindra Naik is asking your views on gold and real estate. Does it make sense to invest in gold and real estate?
Well, I think, when the 2008 quantitative easing started, there was a guy called Paulson, right? So Paulson, who made a fortune shorting the markets in 2008, I think he made billions of dollars. And post QE, he started a gold fund because he felt that the quantity of money that has been printed will lead to hyperinflation, right? And now even more so. So there's a very interesting note by Paul Tudor Jones that you guys should read, which talks about why, while hyperinflation did not happen between the 2009 to 2019 era, that it's now very, very likely. And therefore he's betting on Bitcoin. So I don't have any strong views on gold or real estate, but definitely gold, in case we do have hyperinflation, will benefit as asset prices go up. There are other esoteric views that fiat currency is losing its meaning, and you can have depreciation in the dollar, etc. But those are esoteric views.
So we'll move to the next question. Ankit, yeah. Rajesh, Ankit Modi is asking, as I understand, market will discount future. How do you predict future of pharma and telecom sector? NBFC and banking hit sectors. So what is the potential of these sectors in future? I think you covered it briefly. If you can just put some liners here.
I would just say telecom positive, right? PSU banks. Did he ask PSU banks?
No, he's asking the pharma, telecom sector, right, and NBFC and banking. In his view, they are worst hit sectors.
Definitely, the lenders are the worst hit. and telecom will gain.
Okay, so now we move to the next question. Priyanka Bhatnagar is asking, sir, what is your view on banks not lending to MSME? They are basically parking the funds in RBI. Do you see any improvement coming in coming days or months?
So, I think the government is trying its best. The banks are extremely risk averse at this moment because I think they have gone through a very painful NPA cycle, which has, lasted, actually, which started from 2008, the bubble of 2008 to, now. So we've had a balance sheet, right? Balance sheet recession, a typical balance sheet recession, which the banks have borne the kind of brunt of. So given where they are, and given the investigations that take place in case they lend to borrowers which become NPA, they are clearly very risk averse to lending. So clearly, if government, you can see the measures that they've taken are provide guarantees on the basis of which then there is greater encouragement for banks to lend. And clearly there is money in the system. I think it's a matter of confidence returning.
Okay, Dilip Vora is asking a first question which is related to the global markets. So Dilip is asking, what's your view on the world market? Can they make new lows or will survive or sustain this rise?
That's a $1 trillion question. I think a lot of people are debating this among the stalwarts themselves, whether this is just asset inflation which has been caused by easy money, and whether the challenges of the real economy could be much longer, and therefore does the reality of corporate earnings as you move forward and equity valuations reach a meeting point at some point in time. So it's a very difficult question to answer, but I think India is underperforming clearly, even the global markets, because our challenges are even greater.
So Rajesh, now Priyanka is asking another question. What are the opportunities you can see in financial markets globally in 1 to 2 years?
Financial markets
globally. Open-ended questions. It's a very, very open-ended question. Probably she is looking at what kind of asset classes it will do well in next 1 to 2 years.
Well, I would always bet on equity. Eventually, you'll have to kind of bet on equity. With interest rates being where they are globally, I'm not sure you want to be a fixed income investor. Of course, at this moment, because the Fed is buying credit, right? They're buying high yield bonds, and so there is yield compression, and because of which there's money to be made there. Howard Marks just launched a high yield bond fund because he has this metric, right? There's a saying in the markets: follow the Fed. If the Fed is buying high yield bonds, then there's a yield compression to be had. But beyond that, I wouldn't be a fixed income investor. Equities do well because superior businesses make return on capital employed, which is far in excess of the fixed income yield that is accruing to businesses today, right? And you get coupons, right? So in a bond, right? Once you get an interest rate, you then have to reinvest at a rate which is available at that time. But there's something called retained earnings in corporates, and the retained earnings are reinvested again, and which creates a multiplier effect to your wealth, right? So the value of corporates continues to kind of increase, as you move forward, which makes, if you look at 100-year, track record of equities, they have done well, across cycles over the last 100 years, and the returns have been very superior to almost all asset classes that have been there. So I would say that, as you move forward, look for good businesses, and those are the best places to put money in. Hello?
Yeah, Mr. Ajay has just got logged out. He's reconnecting. Yeah, Mr. Rajesh.
Yeah.
Yes, so Ajay is logging in. In the meantime, I'll just take up one or two questions till time. So one of the question, can you hear me?
Yeah, I can.
Yeah. So one of the question is from Mr. K.R. Vishwa. He is asking how moratorium will be impact on the bond market.
How does the moratorium impact the bond market? I think the bond markets are really reacting to, at this moment, any expansion in, the fiscal deficit. So, if I think the bond markets get a sense that the uh, the government is willing to increase its fiscal deficit to a much higher level, or the RBI is willing to monetize, the deficit, the larger deficit, then I think the bond markets yields would go up and bonds prices will fall. So I think the bond market will react more to that than anything else.
Okay. So the other question which is asked is what is TINA factor, TINA factor?
There is no alternative. Well, I said that in context of if fixed income are giving you such low returns in the US, uh, uh, and which is the other asset class that you will put money in? Um, you know, so basically, then people move to equities, and that's a large market where people can move to for capital appreciation.
Sure, sir. The next question is from Kishore Raj. How do we protect our clients' investments at portfolio level?
That's a very open-ended question.
Yes.
Yeah, talk to us, and at least we'll try and guide you to what can be done.
Sure. And yeah, so that was the last question.
Great.
Yes. I hope anyone, if anyone has any question, you can just type in. We are taking. Sir, would you like to take questions? Move further questions.
Or my sense is that they can email those questions to us, and we can reach out to them and answer those questions. Whatever Ajay can decide.
Okay.
Is Ajay on?
No, actually, he's not yet logged in.
So I think it's best that if people have more questions, let them kind of email to us, and we'll be more than happy to answer those questions.
Sure. I will email our email ID so that you can send the questions and we can forward it to Ajay or Mr. Rajesh directly.
Great.
Yes.
Thank you so much for your time. Thank you, ladies and gentlemen, and it was a nice conversation. I enjoyed.
Thank you, sir, and thank you, Ajay, though he's not there, but thank you for the session, and we regret the inconvenience which was caused at the start of the session. And thank you everyone for attending this. Stay safe.